Today, we'll be speaking about the calculation of taxable income as per the consultation documents that's been released by the Ministry of Finance for corporate tax. This is still not the law, it is only a consultation document, so we do have to expect some changes when the law is out. Before we move ahead, please click on the subscribe button and the bell icon to stay updated on our future weekly business and finance related content, which is incredibly useful for business owners, CEOs, CFOs, entrepreneurs, and those who aspire to be one. Now let's get back to the video. The calculation of taxable income for corporate taxes is a fairly new concept in the UAE. Therefore, it's important we try to understand it in advance so we are well prepared to optimize our tax liability in the future. So how is the taxable income calculated? The starting point of the calculation is the profit and loss of the financial statements of the company. This makes it easier for companies to maintain just one books of accounts. Otherwise, they will have to maintain one for financial purposes and one for tax purposes. What the Ministry of Finance also has said in the consultation document is that the financial year end would be the same as the tax year end of the company. There are many accounting standards that have been adopted in the UAE, but the most commonly used accounting standard is IFRS. In the consultation document, they have not specified what accounting standard has to be used. They have said any accounting standard that is acceptable in the UAE can be used for calculating the taxable income. So it makes logical sense for companies to maintain proper books of accounts and complete an audit at the end of every year. Therefore, they can use these final figures for deriving at their taxable income. Obviously, the net profit is not the final figure. There have to be some adjustments that have to be taken into consideration. For example, some exempt income that have to be removed and some non-deductible expenses, which we'll discuss in future videos. Let's also discuss how unrealized gain or loss is treated. An unrealized gain or loss is basically the change in the value of an asset or a liability, which is creating a gain or a loss without a transaction actually occurring. For example, an investment that is held in hand. It may increase or reduce in value over the course of the year. However, since it's not actually sold, there is no real profit or loss that is generated. What the public consultation document says is that if there is a capital related unrealized gain or loss, it will not be treated as taxable income. However, if it's a revenue related gain or loss, it will be treated as a taxable income. A revenue related gain or loss could be, for example, an inventory item, which is going to be sold in a very short-term basis. In summary, what we can say is that we can use the financial statement's net profit or loss to calculate the taxable income of the company. And this should make the compliance costs for the companies much lower, especially for startups and small businesses. We've now reached the end of our discussion. If you like the video, hit the like button and subscribe to our channel. If you want us to talk about any specific topics, please do let us know in the comment section below. See you in the next one.